been in the real estate private equity business in that 06, 07, Scott, that period you're talking about. I think the real challenge is to, when you see the lenders stretching too much, competing, the real challenge is when is that cusp, and when is it too much, and when do you stop believing yourself?
Even the most disciplined investors have a very hard time pulling the brake. They pull back. We did in 2007, but nowhere near enough. Your investors look at you and say, "What's wrong with you?" The objective is to put. When someone says they have to put out the capital, that's a time to run. But it's very hard to resist.
It's amazing how aggressive the money center banks are. JP Morgan, Bank of America, Swiss, all those companies are just unbelievably aggressive in terms of the money they're trying to put out, the terms that they're willing to provide capital to our company. They walk out the room and go, really?
All mortgages.
No.
Equity as well?
No, not equity.
So that's
lines of credit. Right? We have a line of credit, it's a $5 million credit that we borrow at LIBOR plus 140, so it's 1.7%. There's cheap money out there that drives the basic business.
But in general, the financial institution, the banks and insurance companies have really reduced their equity exposure because of the regulatory requirements, the capital ratio requirements.
Guys, I have one more question, and I'd like to open it up to everybody here. There's been news recently, Salesforce.com just signed the largest lease in San Francisco, 715,000 square feet. LinkedIn signed a deal for 450,000 square feet. Google's growing, Twitter. Are these bankable companies? And what do you see when you look to invest, Scott? What are the parameters you look at in the financial strength of the companies in your assets? But can we rely on these companies to grow long term? It's really bucking the trend from the insurance and financial world. We're seeing law firms are downsizing, financial services firms are downsizing, taking less space, and insurance companies are going with less space as well.
I mean, the answer is they're bankable. You can absolutely borrow on it. What you're describing, I was in Kansas City last week. Amazon is putting a 450,000 square foot distribution facility in Kansas City. They're going to do 50 distribution centers in all the major metropolitan areas around the country. Around those Amazon locations, other fulfillment centers are going to be located, and the institutional capital is chasing that down to the lowest yields possible. So that part, again, this is more detailed than you need, but so in Kansas City, cap rates for industrial properties are 7.5. Maybe the very best might break 7. That is going to trade on a 5.5 in Kansas City. And institutional investors fly over Kansas City. They don't go to Kansas City. But that Amazon credit and the sort of agglomeration that happens around the internet distribution companies is happening in every major metropolitan area around the country. Banks are absolutely willing to lend on it, and equity investors are willing to buy it.
And healthcare, what's interesting about healthcare is, so take the acute care hospital space. There's 5,000-ish acute care hospitals where you go to break your arm, a big operation. Probably 3/4 of those are nonprofit, 80% nonprofit. And of those 5,000 companies, 5,000 are having discussions, strategic discussions right now on internet, because nobody wants to be the last kind of standalone community hospital standing. You think about what's happening in the world, these networks, these narrow networks, and these physician-owned facilities. Think of the recent news on Partners. That's happening all across the country. And then you overlay the fact that healthcare is a regional business, right? It's a local business with incredibly tight antitrust umbrella over it. So the feds have been unbelievably tough on these operators. This is not a partner situation to make sure that no one regional operator has a disproportionate market share. So you have 5,000 hospitals, they're narrowing the networks because they're trying to get to margin, right? You think about the Affordable Care Act, right? People forget that the industry actually supported the Affordable Care Act, which is effectively a trade, right? All the healthcare providers said, the government came to the healthcare providers and said, we'll give you volume. We'll give you 35 million new Americans that have insurance. In exchange, you need to give up margin. And we'll make a bargain. And they kind of bargained back and forth and basically made a deal. And so what happens when any business becomes under margin pressure? They consolidate. So that's what's happening all across the country. Seeing it here, I always think about some of these community hospitals that, have these town fathers that have been on the board, Fair Street Independent. Boy, when the music stops, if they don't have a partner, good luck, because they won't have any doctors, you won't have any referrals, you won't have any network, and they're going to be in a world of hurt. And so from a credit perspective in healthcare, the trends that are affecting the business in real time are challenging to discern.
I think it's
Credit's not credit anymore, by the way. Right? General Motors was bankrupt. Who would ever, General Motors was the ideal AAA credit.
right.
Now you, right?
Yeah, it's amazing to see Amazon.com. It starts with online books, and they're trying to deliver groceries to your house now. It's just amazing transformation of a company. So I'd like to take this time right now. It's about 7:45, and open it up to the audience here. Any questions for Scott, Tom, or me? Gary Holmes?
For Scott and Tom, what would be your top 3 markets to invest in right now?
I work in New York City. New York City is still absolutely on fire. So it's amazing to me, like I'm a Red Sox fan and I'm a Boston fan, so I work in New York, so I don't love New York, New Yorkers, but I can tell you that it's amazing what's happening in New York. Think about the financial storm that they went through, right? Lehman, collapse, and Bear Stearns. Just think about the effect that had on that kind of financial-driven economy and a worldwide collapse in the financial markets. When you go to New York today, it is just absolutely on fire. You have a son that lives there, and the vibe of the place, the vibrancy of the market, the value of the real estate, the value of residential real estate. It's just amazing what's happening in New York. So I hate to tip my hat to New York, but we have a REIT that does nothing but invest in New York real estate. And it's just such a dynamic place again for people to live, work, and play.
It is pretty dependent on the product type and the submarket, but we're looking for markets where the average in-place rents are well below the current market rents. Markets like, for instance, Atlanta or Dallas or Denver that suffered the most decline, that repriced assets very dramatically, where you can buy at significant discounts to replacement cost. The rents, because it was a 5 or 7 or 10 year, it wasn't 10 year average, but let's say 6.5 or 7% average duration on the commercial leases, those rents haven't reset. So in Atlanta, we're looking at an asset where the average rents in place are about $19. The market rate's about $23 or $24, and the rents went down to $16.50. Well, we can buy that asset at $135 a foot. It's $250 or $275 a foot. It's a nice B-plus office building in Buckhead that's got structured parking. It's great. It's a real ride up, but it's a little bit dicey because you have to be careful about the timing, because that market is coming back down too. Those are much more cyclical markets, and you can make money. Those are not buy and hold markets, but those kinds of markets. That's where
We've done a lot of investing in Texas, Dallas, Houston, San Antonio, Austin, and you have unbelievably strong economic growth data that you had for a good period of time. It feels like it's going to continue. You have really solid demographics from plus 65. The challenge with it is still like a wild west, especially there's no certificate of need, there's no real regulatory oversight. People are building these hospitals on top of each other to compete. And so there's a perfect example of a market where you look at it and go, yeah, I love the demographics, I love the growth, I love these assets. But man, what happens long term is he's going to continue to build without a regulatory, in the country for certain healthcare asset class, there's something called a certificate of need. We actually have to show a need to the state or the community that to be built. But those states without certificates of need, such as Texas, and it's dicey.
There's also some inventory, if you think about it. David mentioned the size, the square footage requirement that some of the office users are having, and that is all corporate institutional real estate departments are trying to downsize the amount of square footage that the individual takes. About a third of the inventory that's currently occupied in major metropolitan areas is functionally obsolete. They don't have the power, they don't have the floor loads, they don't have the internet access, they don't have parking. So there's going to be, I actually saw a journal article about this recently, in almost every major metropolitan area, the need for new functional office, where you can have a much more efficient user layout, is if you look out 20 years, is 130 million in just the 4 major metropolitan areas: New York, LA, San Francisco, LA, Boston, New York, and Washington. So, and if you did that, if you did the math on all the metropolitan areas, it'd be 100 million more. of additional offices required, new functional office between 2015 and 2030. So that's another place where, and the cost to build it has increased dramatically, right? If you want to build an office building in New York, it's $750, $800, probably more for the basic office building.
It's also a lot easier to move. A lot of law firms are moving because their whole operation has changed dramatically. It's easier to move than to try to, renovate around yourself. It's really difficult. So it's another, to your point. So in-place functional obsolescence is another trend as well. So any other questions? Billy Crowley.
So most of us are not in the real estate business. And so I guess what I'd ask you guys is if you guys weren't in the real estate business, but you know what you know, you were in another business and you had money to invest, how would you get into the real estate? I mean, other than just going to the real stocks and buying stuff. What are different ways that an investor can get into the real estate market to try to do well, other than just the traditional method of buying real estate?
Well, here in Boston, there's a guy, former partner of my brother Eric's, who started as a Coulston lawyer. He knew a lot of real estate people. He picked some knowledgeable real estate people and bought a big portfolio, 3,000 units of multifamily. Stephen Astor, what's the name of that company? Tamiel Partners. Great group. Really knowledgeable.
I still Scott, that's part of ownership.
I do not own it.
Because I know Scott.
No,
For 30 years, I bet
He did get excited.
No, but you know what? I'm non-real estate, right? I don't need any more real estate. But Stephen, I went into 4 of his partnerships as a limited partner. I had no involvement other than just an investor in his partnerships. And because he's smart, he's hands-on, he's affiliated with good local managers in each one of the markets that he's in. We have a lot of institutional ownership of real estate, but I'm not a real estate expert to run a apartment portfolio in Hartford, Connecticut, which Stephen is. So that's a way to do it. I think though, Tom, going through public entities is not a bad way to get the exposure. Can you have liquidity? Because Stephen's partnership is illiquid for 10 years. So do you really want to go into a partnership? Do you really want to go into an investment that you can't get out of and you're at the mercy of that investment professional?
Boston itself is one of the preeminent places for REIT investing in the country. If you're on a REIT roadshow raising any kind of capital, you come to Boston because of Fidelity, et cetera, et cetera, et cetera. So you can invest in their mutual funds, you can invest in their individual REIT stocks, you can invest in the non-traded stocks, which are illiquid but non-correlated. So there's ways to invest, but look, there's risk in any investment. You have to try to figure out on a risk-adjusted basis, are you going to compensate for the yield? We run our company is 20% leverage, use very little debt. Basically buy our assets, think we buy them all, run them all, pass on the cash flow to our investors on a quarterly basis in a tax-efficient manner. REITs are tax-efficient as well, so you have to think about the after-tax return that you get. But it's not easy.
But if you go into a private partnership, you can take advantage of some depreciation, some expense. So there's a trade-off, right? You as an individual don't have any issues as a tax-exempt investor would have with unrelated business income. So, but look, I think for us as individuals, we all have a home, or many of us have a home. Most people who have a home have a fairly large percentage of their net worth in their home. So how much additional real estate do most people really want to have? And do you really want to be illiquid? I think I probably, if I didn't have the comfort level with the illiquid investments that we own ourselves, I would be really concerned about being tied up for long.
From an investor perspective, so I think I'm a relatively astute investor. I'm not sure I am, but I think I am. It's one of the stories I tell when I do a lot of seminars talking to people about my company. The story I relate is I have 4 children. My oldest son, Patrick was 2 or 3 years old. Patrick's 23 now, so he was 2 or 3 years old. I put probably $30,000 into one of those 504 Fidelity accounts where the money builds tax-free, and it was going to be for his college, and so I forgot about it, and then the years roll forward. So think about the period of time he was going through, right, like 90s, 2000, and then when Patrick was ready to go to school, I literally hadn't looked at it. Go back to the account. So I think I started with 30,200. That account can run to 31,700.
You made money, not
The point being, But just think about the stock market during a period of time, right? It's up and it's down, it's up and it's down. If you're not investing in that right period of time, it's a challenge. And I've often thought if I had invested kind of dividend-paying stocks, where I was getting monthly dividend, sequentially with the well-managed company, how much better off I would have been than Patrick.
Is he paying off those loans? Hopefully not. Any other questions right here?
Yeah, so we have a lot of young people in the room. I brought one of them here who's interested in pursuing a career in real estate. You guys are successful. Where did you come from? How did you get your start? Or what are your recommendations for somebody who wants to play this exciting and complex field?
I'll take a crack at it. Just from the brokerage world, we talk with a lot of young people all the time coming in and saying, hey, what can we do? And I think if you really want to be in the real estate or any other industry is to, like I was saying earlier, you can see we're in real estate all the time. And I can't tell you how many people come in and say, and I ask them, why do you want to get into real estate? And they say, I'm a people person, I really love it, I read about this deal in the paper. And I ask them one question, who owns the Prudential Center? And they look at me, I don't know. So, do some research if you really like it. Learn the big tenants that are in Boston. It's easy to do. You can read about it, you can walk around, learn who the big owners of the buildings are. If someone ever came in an interview and said, I'm really passionate about real estate, what Boston Properties is doing, and Equity Office is doing, and State Street Bank, it would put you right up to the top level, just because you've done some research, looking into it, and you really show that that's what you want to do. Most of the people, I think, they're leaving me to go to, talk to a banker and then an insurance, they're just looking to try to get a job, So if you really want something in that industry, do some research in advance. That's the best place. So.
Commercial real estate, it's leasing. I think it's the best entry point. There's the most number of jobs. You learn every bit of revenue comes from. Nobody wants the leasing job, right? When I was graduating from business school, Trimble Pro was hiring leasing agents. They gave you fixed shoes and business cards and said, go lease space. And that's, but those guys learned the real estate business and they learned where revenue comes from. And there's a lot of those entry-level jobs. To go into Blackstone's real estate business in New York is going to be hard, right? Everybody wants to go to work for Blackstone in New York, and that's the best, institutional investor in the world. That's probably not the way to go in. My son wants to go to be a private equity guy when he graduates from Bates. Me too. That's probably not the place that you start.
If you have $2 million of your own money, you can
Well,
get
it helps you start with $30 million.
$2 million might get you in an
$2
entry.
million is not enough.
Any other questions?
Richard's and Tom's comments about New York market. Yeah, let them know.
Look, once again, being a Boston guy, just New York is just, it's a unique place. And the dynamicism of the city, it'll be interesting to see with the new mayor what happens from New York's perspective. But I can tell you, my son, when he graduated from school, he wanted to live in New York. Confident, determined.
That's
right.
Yeah,
I mean, and
it's a ferocious industry in a ferocious city. How do you?
Right, unbelievably expensive, right? And so we're subsidizing, after, happily, he's got to work in a terrific company. But I don't know. I wasn't. Were you ever attracted to New York? Did you ever want to go to New York?
I did for, my first couple years out, as long as I know I can get out.
For a couple nights. For a couple nights.
So Friday to Sunday. That's pretty
I
good.
don't know if it's a generational thing, but I think, just my kids want to go to New York.
Yeah.
Your friends want to go to New York. It's vibrant. It's really happening. All the neighborhoods come alive. And so you think about New York, one thing that was a shock. Patrick moved to New York. He's looking for a place. Look, I think New York, just think about New York right there. How many people live there, but you know, all the real estate there. The residential vacancy rate in New York is 0. Right, so he's on Craigslist and he finds a place, and if he doesn't call right then at the time of deposit, it's gone. I mean, these are trying to just find a place. Just think about New York. Take a step back. Think about all the real estate that's in New York. It's impossible to find a place to live. So it's just it's an interesting place. I can't say I love it, but it's fascinating on a lot of levels.
And needless to say, we haven't said it, but it's obvious. It's networking. You need everybody you know. You need to connect. You need to reach out. It's word of mouth, and just keep following the paths that lead you. That's just a no-brainer. So.
But just one quick question, because Tom, you were talking about the age of everyone, and certainly that's very relevant, and you talked about New York, and you see Boston, you see the movement into San Francisco, into Seattle, into New York City, and into Boston, and yet you see all these congregate care places in the suburbs. You literally can remember growing up when there were kids in the suburbs, and I have these older people in the suburbs, and the innovation thinkers downtown. What is both of your opinion of the suburbs in the future, in the way America is changing, to Dave's earlier point, and what's happening with the population ages in terms of getting older, because it's obviously hard to live in Midtown at 81 years old. So what's that going to mean to the suburbs of the U.S.?
From a healthcare perspective, I mentioned earlier, it's extending into the suburbs. If you haven't seen it yet, you'll see it. You'll see these companies continue to push into the suburbs. If you look at a graph of inpatient volume, which is large acute care hospitals versus outpatient volume, it's literally like that. You know, the inpatient population continues to drop, so they're trying to push everyone into these outpatient facilities. Technology is getting better, imaging, you can just think of what they can do with these outpatient facilities. And the senior housing business, I think senior housing today is the best business in healthcare real estate. It might be the best business in commercial real estate right now. You think about the demand drivers for the equilibrium between supply and demand. The fact that it's 100% private pay. And one of the big factors in healthcare, you really have to understand is who's paying, or what the payer's mix. Is it government reimbursed or private pay? And so, interestingly, Boston, I was just reading the other day, is one of the cities that's supposedly overbuilt from a senior housing perspective, which I never really thought. We don't own anything in Massachusetts area. It's a product that is susceptible to swings in supply. Like I think from a suburb perspective, at least for healthcare, it's going to continue to grow. And it's just fitting the needs of the community and folks that live there.
And the trend, I mean, it's definitely been a trend for many years to the movement back downtowns, but that trend has diminished in the last 3 or 4 years. I think Cassidy just came out with a paper on that this week. So the rate of growth of movement downtown has begun to diminish, and the rate of growth of movement to the exurbs has begun to increase. So I don't know the answer to the question, but the idea that everybody's going to abandon the suburbs and move downtown is an idea whose time has come and gone, I think.
Any other questions back?
Yeah, where are you in 25 years? Which cities? If you were to invest right now.
Most. I see the horizon. Most of you.
The cage.
It's got a best guess. I'll do this.
I don't understand the question.
Like if you were to invest right now, which city or metropolitan area do you see growing the most in 25 years?
I'm not sure that I would make that my criteria for making an investment.
Okay, I'll rephrase it. Your best return on your investment.
I think that the stock answer would be you look at the demographic growth and it would be southern tier cities. It probably is the case that California and the western markets are going to grow the most dramatically. There's probably the most appreciation to be had long term in those markets, but you can't get any return during the life of the whole, right?
Yeah.
So right now we want to buy an Inland Empire. Everybody wants to buy an Inland Empire. It's a 4 cap. It's lower than a 4 cap. It's negative leverage on the debt if you amortize it all. But very long term, if you have the stomach for it, owning property, owning distribution product in California is probably going to be a good long term bet. Most investors need a combination of income and appreciation, and so I think even though I might think that wouldn't be where I choose to go.
Just think about it, 25 years, so with the growth of the plus 65 population, 25 years, there'll be twice as many 65-year-olds walking around the country. So close your eyes, it's double the number of 65-year-old Americans in the country. Just start to think about the ramifications that have to almost every business, to real estate, to finance. We always talk to our financial advisors who, on the non-traded side, they sell a lot of our products. These folks provide financial advice to their clients. All of a sudden, they're starting to deal with the fact that all of a sudden life expectancy is continuing to grow, right? So if you're a couple, say you're 60 years old, statistically one of you are going to live to be 92. And all of a sudden, from a finance perspective, you're really able to kind of have enough investable wealth to carry you through those years. And then the ramifications of that plus 65 population, plus 85 population has on the country.
If you expand that question, I would have had
If I can piggyback off of Palo, though, I think, we're younger by a few years, and I live in California currently. Do you get concerned at all about environmental factors? In California, we're experiencing the worst drought in history, and being out there, and I travel up and down the north and south, there's a general fear out there that we won't have enough water in 25 years. And we're looking immediate, right? We're looking and saying healthcare demographics are strong, distribution centers for Amazon are strong. But just from our perspective, it's like, hey, are there environmental factors buying on the coast that you guys take into account as well when you, let's say, build a pro forma or a model or whatever?
I don't mean to be coy, but no.
Okay. And I was just curious.
I think the answer is that I think in general, many institutional investors think that technology will answer that problem.
Yeah.
It's not a question of the availability of water, it's the cost of the availability of water.
Mm-hmm.
So you can desalinate a lot of water, right? And they've done that in all the Middle Eastern countries. It's too expensive, but the cost of that is coming down. It hasn't come down enough. There'll be water, there'll be those resources. I think technology will answer the problem. The question is the economic trade-off. I don't know, but those very 400 Atlantic was for sale in Boston. A great asset. It's Goulston Stores headquarters. It's beachfront property. It's a great asset. Many of the investors that bought it were worried about global warming and the rise of the ocean there. We were worried about that. It's not that I deny that that's happening, but over the next 10 years for that commercial real estate investment, it's just not, of the 15 things to worry about, it's not among the top things to worry about.
We'll take one more question. Mark?
Thank you. Scott, it's funny you mentioned Africa a second ago. I was just with 2 Kenyan residents last night, and they absolutely say the place is exploding over there. So they would agree with your observation that you probably should buy some real estate in Africa. Because apparently,
So Colony Capital, our partner, has what's called a MENA fund, a Middle East and North Africa fund, and they're finding, and the reason I thought to say that was that not only can you get unbelievable appreciation if anything good happens on the continent, but you can get current income. In their markets where not only is there tremendous infrastructure growth that's coming, and China is putting tremendous capital into the infrastructure in Africa, but those countries are beginning, not all of them, obviously there's all kinds of trouble, but many of those economies are getting some sophistication, getting some regulatory parameters. Things are beginning to make sense. And it's only the very beginning. But if you ask where today, in 25 years, if you look back, boy, if I could have gotten into Kenya at the time of this time frame, you look back 20 years from now, it's going to be good.
it's exactly what they said.
You gotta
The Chinese are
start somewhere.
building all the roads and bridges over there. It was amazing hearing that. But as a committee member, I thought you guys were amazing. So hopefully I just want to say how good you guys have done tonight.
Thank you for having us.
You might be the first person.
Do you have anything to add, Tom, Scott?
Look, I certainly appreciate you offering to ask me to try to spend some time. Once again, I really have such a love of debates, and it shapes so much of my life. And I'm really excited, obviously, my younger brother Megan's going to be attending debates next year, which is one of the happier days I've had for a while. To see that she wanted to attend debates up to, because we can see my 2 older sons to attend. So, thank you. Thanks to you. I certainly enjoyed chatting with you. It's fun.
What he said.
And ditto, thank you everybody for coming. It's been a lot of fun.